Chinese deflation versus US inflation. Is deflation actually good? Hello, members, super savers, and bond course fans. I hope you're healthy and well. So it seems China, tariffs, and inflation are top of mind for many of the savers in our community. And equally important, it seems there are a few points about deflation versus inflation that need to be clarified in light of the questions and comments we've seen over the past week. So, with that in mind, here are the three topics that we'll be covering in today's video. 1. Is deflation, like what China is currently experiencing, actually good? And might it help protect you from inflation? 2. What is our May I-bond rate projection, and should you buy I-bonds now or wait? And 3. What about the upcoming auction for the 5-year TIPS, Treasury Inflation Protected Securities? As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. Is deflation, like what China is currently experiencing, actually good? As many of our Diamond NestEgg regulars know, China is currently going through a period of both consumer and producer price deflation, meaning that prices are falling over time instead of rising. So it seems some of you are wondering, what's so bad about this? Lower prices are good, right? Like getting my favorite brands for cheaper. Well, yes and no. Lower prices are good if they're a result of efficiency, increasing productivity, and fair competition. They're bad, though, if they're a sign of a struggling or even shrinking economy. Here's why. First, deflation discourages spending and investment. When prices are falling, people and businesses often delay purchases in anticipation of even lower prices. Why buy a car or invest in new equipment today if it would be cheaper tomorrow? This postponement of spending causes demand to fall further, leading to weaker consumption, reduced business revenues, and even more deflation. In short, deflation may choke off economic activity. Second, deflation increases the real burden of debt. Deflation makes money more valuable over time, which means that debt becomes more expensive in real terms. For example, if you owe $10,000, that amount doesn't decrease, even though your income may be falling along with prices in a deflationary environment. So, while your wages or business revenues shrink, your debt payments remain fixed, making them harder to repay. This puts enormous strain on households and corporations, and yes, also on governments with large debt loads, like currently in China, for instance, but more on this shortly. In extreme cases, this may lead to defaults and even financial crises. Third, company profits shrink, wages fall, and unemployment rises, and a vicious downward spiral may start. As prices decline, so do corporate revenues. Businesses respond by cutting costs, which often means laying off workers, reducing wages, or freezing hiring. Lower wages further reduce demand, reinforcing the deflationary spiral. Profit margins are squeezed, particularly in industries with high fixed costs, leading to slower investment, lower productivity, and in many cases, business closures. Fourth, central banks have limited tools to fight deflation. Unlike inflation, which can be countered by raising interest rates, as we all experienced here in the US in 2022 and 2023, deflation is harder to combat because interest rates can't fall below zero very easily, a problem known as the zero lower bound. Not that it hasn't been tried. Most of Europe had negative rates for quite a while after the great financial crisis of 2007-2008 and the euro crises that followed shortly thereafter. But when rates are already low and deflation sets in, central banks may struggle to stimulate borrowing and spending, as the mixed results in Europe show. So, while deflation and the thought of lower prices may sound good in theory and at first glance, in practice, deflation can cripple an economy because it sometimes reduces demand, inflates outstanding debt burdens, lowers wages, kills profits, and traps policymakers in a cycle that's very hard to break. That's why central banks aim for moderate inflation, around 2%, not just to avoid overheating the economy, but also to prevent the downward spiral of deflation. And that is what we're seeing in China. Yes, it controls 1/3 of all global manufacturing capacity. That's this red line here on the share of global manufacturing chart from the Wall Street Journal. And yes, that is more than the US, Japan, and Germany combined. But this dominance in worldwide manufacturing does not appear to be enough to overcome deflationary pressures within the country. And that's no surprise, given some of China's key weaknesses at the moment. Its bad debt hangover built up from years of breakneck growth and investment, its property bubble burst post-2020, and its low birth rate and shrinking working age population. As we discussed in this recent video on whether China just beat President Trump in the current ongoing tariff saga, linked below in the first pinned comment for those of you who may be interested, it remains to be seen how China will dig itself out of this deflationary hole, especially with the continuing tariff fight against Washington. Thankfully, for most of us in this country, the last true deflationary period for America was during the Great Depression of the 1930s. And no, falling prices in China may not necessarily be helpful for us here in the US either. If these falling prices get exported to the US by ever cheaper imports, this may put enormous pressure on the US economy because domestic producers may not be able to meet those ever falling prices and go out of business, to which the US might react with higher tariffs that may cause volatility and disruptions as well, just as we're currently seeing in a live experiment, so to speak. So, now that we understand that lower prices in the context of a struggling or even shrinking economy may not be good, let's move on now to the next section of this video and talk about the opposite of deflation and the more applicable concern to us in this country, inflation, and how we might best be able to protect our money should inflation make its ugly comeback. What is our May I-bond rate projection, and should you buy I-bonds now or wait? I don't think I need to explain why persistent high inflation is bad to most of the savers here. We've all experienced post-COVID inflation firsthand, and it was clear how ugly that was. So let's focus on the two types of inflation-protected treasuries that interest our community, starting first with I-bonds. And let's begin with the fixed I-bond rate, because that's what's most interesting for many of you. As our Diamond NestEgg regulars have heard me say often, no one really knows exactly how the Treasury sets the I-bond fixed rate. But based on our analysis dating back over 2 decades, it appears to us that since 2015, if we take 65% of the average daily real yield on the 5-year tips for the 6 months prior to the I-bond rate reset date, this, together with a bit of rounding, gets us most of the time almost exactly to the fixed rate that is then announced by the Treasury. TIPS, Treasury Inflation Protected Securities, are the other type of inflation-protected debt that our government issues. So let's calculate our projected I-bond fixed rate. Here's the average daily real yield on the 5-year tips from November 1st, 2024 until close of market on Monday, April 14th, 2025. Multiply this by 65% and we get to a projected next I-bond fixed rate of 1.14%, which we then round down to 1.1%. And this 1.1% is the fixed rate that we expect for all I-bonds that will be issued on or after May 1st, 2025. This is a bit lower than the current fixed rate of 1.2%, but this should come as no surprise given that real yields on tips have gone down a fair bit over the past several months as well. Although I'm sure some of you who bought tips last Thursday and Friday when yields briefly spiked at the height of the market panic around tariffs, you're probably feeling a bit smug about your timely secondary market purchases right now. But more on tips later. Let's move on to the projected I-bond inflation rate for now. Here we have the CPIU all items number for March 2025. Divide this by the CPIU all items number at the end of September 2024, the starting point, -1, and we get to this percentage change in CPIU over the past 6 months. Multiply this by 2, and we get to an actual annualized I-bond inflation rate of 2.86%. And of course, let's not forget about what we at Diamond NestEgg lovingly refer to as the bump, the inflation adjustment on the fixed rate, which is basically these two numbers multiplied together. When we multiply the projected I-bond fixed rate and the percentage change in CPIU over the past 6 months, we get to a projected bump of about 0.02%. So to get to our projected combined I-bond rate for May, let's add together our projected I-bond fixed rate, our actual I-bond inflation rate, and our projected I-bond bump. This results in a projected combined I-bond rate for May of 3.98%, which, as you can see, is quite a bit higher than the current rate of 3.11%. This table may help you with your decision on buying I-bonds in April versus waiting until May or later. This column shows the month of purchase. This column shows you the fixed rate that you will get. The fixed rate stays the same for 30 years, the full term of the I-bond. This column shows you the inflation rate that you will get. The inflation rate changes every 6 months. So, if you buy in April, you'll get a guaranteed fixed rate of 1.2% for the full 30-year term of the I-bond, but a lower inflation rate to start for the first 6 months. And if you buy any time from May until the end of October, you get this projected fixed rate of 1.1% for the full 30-year term of the I-bond, but a higher inflation rate to start for the first 6 months. As our Diamond NestEgg regulars know, I-bonds serve a dual purpose in our portfolio as an inflation-protected emergency fund, as well as inflation-protected retirement savings. So in our personal situation, my preference would be to buy I-bonds this month because this current I-bond fixed rate of 1.2% is the second highest I-bond fixed rate in more than a decade and a half. Plus, I already know what my inflation rate will be in the first 6 months and what it will be in the second 6 months, meaning that I also already know what I will earn in my first year of owning those April purchased I-bonds when I buy them, about 3.6%. That's this 1.2% fixed rate plus these two inflation rates added together divided by 2, because I only get each of these inflation rates for 6 months, plus a tiny bump of about 0.02% for the full year, giving me an annualized rate of about 3.6% for the first 12 months if I buy my I-bonds in April. If I buy during the May through October period, my I-bond fixed rate will likely be lower. And while I'm starting off with a higher inflation rate for the first 6 months, I don't know what my inflation rate will be in the second 6 months. As the old adage goes, a bird in the hand is worth 2 in the bush. Plus, who knows, right? Given that Treasury Direct does not publish its fixed rate formula, this projected 1.1% is our best guess based on our analysis of historical I-bond data. There may be other factors that Treasury Direct considers, which we are not aware of, that could lead this projected fixed rate to change. But to say it again, the new I-bond rates we've discussed today are expected to go into effect for all I-bonds issued on May 1st through to October 31st, 2025. So to still get this current fixed rate here, if that's what you want, you will need to make your I-bond purchase before April 30th, meaning on April 28th or 29th, possibly earlier if you want to be on the safe side, because Treasury Direct needs at least 1 business day to process I-bond purchase orders. If you buy your I-bonds on May 1st, you will not get this old rate. You will get the new one. Now, if you're still undecided at this point, another option to consider is to split up your I-bond purchase. For example, buy $5,000 of your $10,000 annual limit before the end of the month to lock in this fixed rate of 1.2%, and buy another $5,000 after you know what the rate will be on May 1st. Also, remember that for I-bond purchases, regardless of whether you buy at the beginning of the month or the end of the month, you will get interest for that entire month that you purchased your I-bonds in, meaning that even if you buy your I-bonds on April 28th, you will get your I-bond interest for the full month of April. So, Now that we've covered I bonds, let's move on to the other inflation-protected security that the Treasury offers. What about the upcoming auction for the 5-year TIPS, Treasury inflation-protected securities? Remember that the real yield on the 5-year TIPS is what we believe forms the basis for the I bond fixed rate calculation. Here's the expected coupon and the expected real yield for the 5-year TIPS auction on Fidelity's platform at the time of this taping. This auction is scheduled for this Thursday, April 17th, and these numbers can and usually do change all the way up to the time of the auction. This chart may also be useful. 5-year TIPS real yields, the yield after inflation, remain at some of the highest levels when compared over a 15-year period, despite having come down a fair bit since their brief spike last Thursday and Friday, as I mentioned earlier. At the close of market on Monday, April 14th, 2025, the break-even inflation rate was 2.35%, which is quite a bit higher than the 15-year average of 1.91%, but more or less in line with the average of 2.31% since the beginning of 2024 up until now. A 5-year break-even inflation rate of 2.35% is also still less than the latest BLS inflation numbers of 2.4% for March 2025. So, if the 5-year TIPS fits your timeline, goals, and expectations, and you want to add some inflation protection to your overall portfolio because you believe that inflation over the next 5 years will average more than 2.35% annually because of higher tariffs, for example, then this may be an auction to consider dollar cost averaging into. TIPS, however, are less straightforward than I bonds, and their complexity can sometimes be a deterrent for investors. As I always say, everyone's financial journey is different, and never buy what you don't understand. So it may be useful to check out this video here first on whether TIPS or I bonds may be a better fit for you. Or better yet, join our bond courses. Bond beginners, folks, please refer to Module 6 on TIPS in the course and Module 7 on I bonds if you need a refresher on either. So, who's buying I bonds, who's buying TIPS, and who's buying something else altogether? Drop a comment below and let me and the community know. All right, members, super savers, and bond course fans, I hope you enjoyed this video and learned something new. And as always, if you want to learn more about how to build a stable, predictable income stream in times of market uncertainty and volatility, while bond yields are still quite attractive, then check out this video here on our bond courses. And come join our next live member Q&A on Saturday, April 19th at 5 p.m. Eastern Time, 2 p.m. Pacific Time. We'll be diving deeper into the 2, 5, and 7-year T-note auctions and all things fixed income. I've also linked all the details on our bond courses and YouTube Super Saver membership below this video for your convenience. And see you again very soon with more brand new wealth building content for your financial journey.